Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me is Vivek. Markets are at the day's low. The Nifty is now just about at the 22,400 mark, having given up close to about 85 points. The Sensex down close to about 230 points. The problem in the market is IT. The Nifty IT index is down 3.5%. So despite banks doing well, Reliance Industries at least not declining, perhaps marginally in the green, IT is single-handedly dragging the benchmark indices lower. And here, in a nutshell, the principal concern is this entire global uncertainty, the possibility that US growth slows down will hurt IT. Investors are now in a wait-and-watch mode. Decisions are not being taken because you do not know what's coming next. And therefore, the expected recovery in FY26.
Expected recovery, expected rate cuts, right?
No, I mean, so the street was expecting that in FY26, growth will pick up for IT versus FY25 and FY24, which were tough years,
right,
because discretionary demand spending came down. So that expected recovery, growth was expected to get back to 8%, 10%. That's not playing out. And now companies are, sell side are lowering their estimates on IT. So that's the problem.
So today, I think two brokerages, both
Motilal Oswal and Morgan Stanley, have both cut the growth estimates for IT across the board for the coming 2 years.
In a little while, we'll discuss that a little deeper. But some other sectors also in focus, like you mentioned, a very choppy trading session. The intraday recovery sold into quite significantly. The only good part of the market is the fact that the banking space yesterday that saw significant sell-off, especially in IndusInd Bank, that has recovered quite sharply. And Kotak Mahindra Bank yesterday was very strong. Today has continued to see strength. The other stock on the radar is actually Tata Motors. Yesterday, the company had an analyst meet. They reiterated their Q4 guidance, and this is something that the street has taken positively up almost 3% today. But on the other hand, one stock that's seen significant selling pressure is PB Fintech or Policy Bazaar. Remember, the company has gone ahead and approved the investment of close to 700 crore in PB Healthcare to acquire a little over 33.5% stake. The street clearly selling into that particular development. And Zydus Life yesterday made a very interesting acquisition. The only problem that the street has pointed out to is the fact that it appears to be a slightly expensive acquisition and will be EPS dilutive in year one. Under the back of that, as we can see, Zydus, which has been a significant underperformer, that particular stock has continued to see selling pressure even in today's trading session.
Okay, let's get to the other big story, and that's brewing in the telecom space. Bharti and Reliance Jio have both announced a tie-up with SpaceX, via which they will offer Starlink satellite broadband services to their subscribers. Now, this partnership, in principle, can expand connectivity to underserved regions where the traditional networks are limited. So what does it mean for Bharti and Reliance Jio? One, increased revenue opportunity. Earlier, Starlink was seen as competitors. Now there will be collaboration, which means some sort of a revenue sharing agreement. Bharti Airtel and Reliance Jio can sell Starlink solution through their retail stores and their online platforms. Also, the earlier fear was that Starlink will disrupt Bharti and Reliance Jio's existing terrestrial services. But analysts we spoke to say that's unlikely to be the case. Starlink, in fact, will be a complementary premium satellite broadband services, which will be complementary to the existing broadband or fixed wireless service that these companies offer. Now, the big question is, can SATCOM, that satellite communication, become mainstream in India in the medium term as it's been globally? Now, here it all boils down to affordability because Starlink is a premium service. Now, the IFL analyst we were chatting with earlier told us that Starlink pricing in the US is approximately $80 per month. Even in a developing economy like Kenya, it's priced at $10 per month. And there also you're going to get limited GB, like, data, 50 GB of data, which is still very expensive. In India, ARPUs are averaging $3 per barrel. If you look at broadband services, ARPUs are at $3 per month. And for broadband, you get at $5 per month. And you're getting unlimited data. So it all boils down to pricing. So that's going to be, one of the key things to watch. Most say that, the revenue uptick may not be that much because this service will target select businesses or very small businesses who have that requirement. Also, another important thing to note that it's not an immediate revenue spinner. The launch is not immediate because Starlink needs government approvals and spectrum allocation in India still needs to be done. So that's the quick brief about the developments taking place. But let's invite Sanjay Kapoor, entrepreneur, TMT advisor, ex-CEO of Airtel India and South Asia. He's joining us on the show now. Sanjay, always a pleasure to have you on CNBC TV18. This is Rima here. So first, share your initial thoughts. Both of them are partnering with Starlink. I'm sure you also have read the headlines, right? The whole of last year, there was public sparring between the two. They were concerned about Elon Musk's entry into India, and now they've joined hands.
Morning, Rima, and good morning to all your viewers. Absolutely a pertinent question, and where we stand today actually emanates from the cardinal rules of telecommunications. Telecommunications is a service which is based on interoperability. It is an industry which over time has demonstrated to the world that collaborating is equally important as competing, and therefore you see tower companies and many other assets really shared between operators. And finally, the telecommunication service providers have to be technology agnostic. They cannot be married to any technology. It's 5G today, it could be 7G tomorrow. It could be satellite today, it could be something else tomorrow. And therefore, they will look at all possible avenues of reaching out services to their customers. And that's exactly what is happening in India right now. It's not one bit of surprise to me that both Jio and Airtel have tied up with Starlink, and they will do it with other service providers on satellite as well as time passes. Now, the challenge is that with these services, they want to reach out to those customers who are unserved, where terrestrial networks don't reach. This could be because of a couple of reasons. First of all, those areas where the government of India, because of security reasons, doesn't allow you to go. It could be because the terrains are really difficult and therefore you don't have the wherewithal to support those networks. And the last is the commercial returns on your investment. So there's a lot of ground in which the amount of investment that you have to put in doesn't return your capital. And, the government over time on the universal services obligations has not been able to really move the needle on serving such like customers. So I think absolutely right. These are complementary services which will probably reach out to the ones who are not served. But the dilemma in India is, in a market which is so low on ARPUs, will an individual customer residing in such far off places, will they be able to afford the services at the prices that they operate even in Africa, which is subsidized, I believe? It'll be very tough for those guys to afford these sort of services. Therefore, I think rightly, if you read Airtel's statement, and if you even allude a little bit to what Jio has to say, I think they're concentrating on serving the so-called B2B market, where either it's a healthcare service which is supported by the government of India, or there is some offshore drilling, or there is some other excavation that's happening on behalf of a large corporate, so that there's somebody who can afford and pay those. And the only thing is that they are deprived of those services today because the terrestrial networks have not reached there. So I don't see these services to be a threat. I think they're complementary, and smartly, the existing operators have tied up and also sell their CPs from their so-called outlets and shops, because they want a complete check on how fast the services are moving, what's happening, what types of customers. They want to dig into the whole knowledge, and they don't want to be surprised at any moment. Your last question, it is always the fear of the unknown, that when somebody comes in, and especially with the stature of Elon Musk, then you fear that, can he be more disruptive than what we can, imagine today? And I think that's the fear. But having been in this industry for that long, I don't believe they can ever disrupt the terrestrial networks, because India has a very strong regulation around who can provide these services and who can't. And I don't think the laws will ever permit the satellite providers to actually dethrone or overturn, any one of these operators.
Sanjay, all points very well put. You said that it's unlikely to take off, with regular consumers, B2C. The real opportunity could be B2B, which is what even the press release seemed to allude to. So how big is the B2B opportunity? What kind of revenues can Jio or Airtel expect from it?
It's a very catch-22 situation, because if the market was overly large and the terrestrial operators had some sort of a gauging of that size of the market, or a so-called addressable market, they would have by now gone and invested. I think that they have not invested thus far tells me that they are either tentative or really they don't see the market to be that large. So once these terrestrial operators get there, I won't be surprised if they will also serve as the guys who will go and create that market for the terrestrial operators, because if the market really becomes of scale, then why wouldn't a terrestrial network put on their own network over there? So I think it's wait and watch for the moment. Nobody understands. It's difficult for us who live in these big cities and who are consumers to imagine that there are very large corporates who are waiting to be served there, can really pay a lot of money, and there's a lot of revenues and profits to be made. But the terrestrial networks have been, the network providers have been daft not to have encashed on that opportunity. So I think the jury is still out. We'll all figure out as time progresses and the services roll out.
Mr. Kapoor, the other question is, like we just mentioned, what kind of a tentative timeline can we work with in terms of actually being able to use these services? And secondly, can this give a material upside to ARPUs as far as, all of the incumbents are concerned? Because, that's been something that the industry has been asking for quite some time.
As far as the timelines are concerned, I think the technical availability of these services and a commercial application and rollout has already been demonstrated in some parts of the world. So I don't think it's a delay from the satellite service providers or now even the terrestrial network providers to partner with these guys. I think the delay is more on the part of regulation and government, where we need to have a firm policy on what happens to the spectrum, because it's a shared spectrum. If it's an administrative charge, then what is that administrative charge? Therefore, they can price it accordingly. And finally, what happens to things like lawful interception and all the controls that the government wants to build in to make sure the services are not, utilized by people who should not be utilizing them. So I think that's primarily the delay. Now to come on to the timelines, I personally think the technology doesn't wait too long, and the life cycle of technologies have shortened. Therefore, to delay it for overly too long would be not pro for us. We should experiment with this early. Now, finally, coming on the ARPU question of yours, I think to begin with, at least in the first couple of years, the ARPUs and the revenues from here will be very small and experimentational. And I don't think they will move the needle for either Airtel or Jio, at least in the next couple of years.
Sanjay, always a pleasure listening to you. Thank you very much for joining in today. Get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we're focusing on precious metals.
Yes, we're doing that because there's just so much chaos and uncertainty in the international markets on what way the tariffs are going. And that's exactly the reason that you have seen the safe haven buying come back strongly in case of gold and even more stronger in case of silver. So if gold prices gained up by a percentage point overnight, silver gained up by 2.5%. And we are inching very close to that 1 lakh rupees a kg mark yet again for the silver prices, with stakes much higher when it comes to silver, because silver is not just safe haven buying, it also is industrial metal, and demand for that seems to be going stronger. That clearly seems to be supporting silver. But the markets also are gaining because the US dollar index is now trading at a 4-month lows, and that clearly has been supportive. For gold prices, we've seen 2,900 regain in the sense of the markets there. And starting today midnight, US is imposing tariffs of 25% on metals like steel and aluminum, and that seems to be impacting markets in sense of inflation and uncertainty going forward. Well, while we do know that the US and Canada will hold conversations for the next 2 or 3 days, so there is going to be choppiness in and the markets are expecting more uncertainty there. The expectation also is that you could be looking at more stimulus coming in from China. That has been more supportive for silver rather than gold. And if you look at the chart in this year, we clearly have seen nearly 11% of gains come in for gold and 14% for silver. So silver clearly outperforming gold, platinum, palladium at this point in time. What the street will watch out now is the US inflation data that comes in today, and that would set you for the US Fed meeting for 18th and 19th March. So these are the two major events, especially from US in sense of data and events, that the street will keep an eye on.
Thank you very much for that, Manisha. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in on the other side. Welcome back. Let's talk about the tech troubles that we can see in the markets. The Nifty IT index is down 3.5%. Wipro, Infosys down more than 5%, while HCL Tech is down close to about 3.5%. The problem is the street investors are now downgrading their earnings estimates. So today, Motilal Oswal has downgraded Infosys to a neutral, Wipro to a sell, and LTTS to a neutral on the back of valuation discomfort. Tech Mahindra, though, has been raised to a buy, and their target price in 1950 implies a little bit of an upside, 30% upside from current levels. The reason for the downgrade is the sentiment has turned cautious amongst clients from January to March. Most investors are adopting a wait-and-watch approach. And therefore, the earlier play in IT was play the companies which benefit from a discretionary demand revival, the likes of Infosys and Wipro. But now Motilal Oswal says the better companies to play in IT would be ones where you have a higher risk reward. And therefore, they've downgraded Infi and Wipro, which were seen as beneficiaries of the discretionary demand picking up. Basically, they don't expect discretionary demand to pick up. And therefore, the growth pickup in growth that they were anticipating in FY26 and FY27 is unlikely to play out. So they've slashed the growth estimates across the board for IT companies. So for TCS, earlier growth forecast was 6.2% for FY26. They've brought it down to 3.5%. For Infi, growth is now seen at just about 5%. Wipro is seen sub 3%. Basically, FY26 is seen in mid-single digits, while FY27 growth forecast is seen in mid to high single digits, ranging between 5 to 7.5%. So that is disappointing. That's the problem, that clients have turned cautious, and therefore growth is unlikely to pick up for IT companies. Morgan Stanley too has downgraded Infosys to an equal weight, target price lowered to 1740. They're also forecasting a slower pace of recovery, moderate growth for a prolonged period. Their key trades are TCS over Infi, Tech Mahindra over HCL Tech, Coforge over Emphasis. Also on the subject of valuation, they're saying that despite the recent corrections seen in IT names, valuations are still at a 5-year average, which is about a 14.5% premium to Sensex. But the long-term average for IT companies relative to Sensex was trading at about a 5% premium. And given that we are in a period of a prolonged growth slowdown, things are looking a bit murky, they believe there is scope for earnings downticks and even PE derating to take place. So, two negative calls.
Consistent downgrades in the IT pack, and the sector, the weakest sector in this session today. Well, moving on, time for a technical check on the market. Mitesh Thakkar joins in. Mitesh, thank you so much for joining us. What are you making of the markets at current levels? We've seen a bit of a sell-off from the day's high.
Yeah. So I think, good morning. One, the markets, haven't given a reversal on the upside, failing to get past 22,600. But I think 22,300 is the pivot which I'm watching. We've been contracting within this range for the last 2.5, 3 days. And the idea is that in case we break 22,300, then I think we might get into a marginally declining mode again. Otherwise, we'll keep chopping around, and the reversal on the upside will happen once we start getting past 22,600.
Mitesh, your individual calls for the market?
Yeah. So on the stock side, I have a sell on Ramco Cement. With a stop at about 826 and a target of around 780. And the other one is a buy on Reliance with a stop at about 1230 for a target of 1285.
Thank you so much, Mitesh, for joining us and giving us your view on the market as well as your individual stock calls. Well, Nigel joins us. There's some development as far as Tamil Nadu cement companies are concerned. Both Ramco and Dalmia are under pressure. Nigel, over to you.
Well, that's right. Ramco as well as Dalmia Cement, both of them are under pressure. And the street was puzzled as to why did we see such a big downtick on both these two names. The problem is that the Tamil Nadu government has gone ahead and now they have levied 160 rupees per ton on limestone that is mined. Earlier it was proposed, now this particular proposal has been passed. So that's why it's viewed negatively for these two companies in particular, because they have a high percentage of their total clinker mix that is in Tamil Nadu. For Ramco, it's close to around 45 to around 50% or thereabouts. And Ramco is the highest exposure to Tamil Nadu. So that's why, because as a percentage of their total clinker capacity, close to 50% is in Tamil Nadu. While for Dalmia, it could be in the vicinity of around 20 to around 25% or thereabouts. What happens next? Well, other state governments as well, since the levy of royalty on some of these minerals is in their hands, the other states as well could go ahead and start levying a similar amount of royalty, which will be a worry for the profitability aspect. What can the cement companies do? Well, they can go ahead and they can try to push it through via price increases. But as we know, prices have been rather weak. However, on the flip side, it could give reason to some of the cement makers that because of some of these royalties that are imposed now, we'll have to go ahead and increase the prices. Just a back of an envelope calculation, 160 rupees is the total hit if this price is not passed through. And for Ramco, it will be close to around 50%. So that will be close to around 80 rupees approximately. While for Dalmia, it will be in that vicinity of close to around 40 rupees on a per ton basis. As it is, the profitability has been under pressure. So for the time being, there's a bit of a knee-jerk reaction that you've seen both on Ramco as well as Dalmia because of this 160 rupees royalty that's been imposed on the limestone that is mined in Tamil Nadu.
Thank you very much for that important update. We will slip into a very short break. We'll come back and track the macros, the global markets, economy. Manish Dangi from Mosaic Asset Management joins in on the other side.
Welcome back to Trading Hour. Well, Manish Dangi, CEO and founder at Mosaic Asset Management, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Manish, for joining us. Well, at the current juncture, what are you making of the markets? There's been significant price correction. Any sectors you find attractive at current levels?
So if I'm more of a macro trader and actually trade beta instead of micro of it. In general, I think markets have sort of down-corrected a bit, but I think the pain is still out there. You still have 6-8 months of listless in the best case scenario, and perhaps, sort of even more downturn from here. So that's a big picture macro story. What I don't like, of course, is anything to do with what China makes well or US imports. I think those are the sectors which are going to get hurt sort of pretty significantly. Given that the Indian cyclical downturn is not very deep, anything to do with India consumption at margin, is where you should sort of begin to dial up. Finally, the next bull market, as it always happens, is led by BFSI, most importantly, banking. So, we've had sort of stresses, in very, very small financiers like microfinance, moved into mid-sized banks, and now at some point in time will enter into large-sized banks. So I think from a sequencing point of view, the incremental beta should be dialed in through financiers. So that's a big picture view of how I would dial up risk at margin in markets now.
Manish, let's talk about the global markets and economies at large. Now, US economy, do you think it's likely to get into a recession this year? There is talk about stagflation. Last week, we were talking about stagflation. This week, we're talking about recession. But, I mean, the US exceptionalism, right, is being questioned now. The AI dominance is now being challenged by Chinese makers. Some of the economic indicators are flashing warning signs. So what is your expectation of how US economy is likely to perform in the next 12 months and what it means for Fed rate cuts?
So in US, there are a couple of things. One, of course, in US, a little bit of a self-inflicted wound. Between DOGE and tariff, they didn't have to do it, and yet they're in some sense, as if imposing austerity on themselves, and it's an active policy, so to say, to achieve something, and which that something is a little bit of a, I guess. I guess a policy shift in US. Of course, the side effect of that will be slower economy. So far, US is sort of pretty steady. I kind of thought 6 months ago that US would enter in significant slowdown by now, but hasn't happened. So, but to a certain extent, between those and tariff, it's likely that in next 6-8 months, US actually sort of very, very sharply slow down. That's one. But from a pure market standpoint, US has sort of other problems. One, pretty much like 2022, you are starting to see earnings roll over there in the tech market particularly. And so both investments are taking a hit there at margin. At least 4 or 5 months, if you're watching US tech earnings, they're starting to roll over. So I think that's going to be a bad news. And on top of it, as you said, China is clearly threatening US's hegemony in tech. And so to that extent, this exceptionalism, and US exceptionalism, by the way, has been mostly about techs, since 2006-07. I think that's getting threatened. So in some sense, if you were to sort of look at one market which perhaps is sort of most overvalued and is likely to get threatened most significantly, both from a fundamental standpoint, but also from the point of view that, there's been a huge positioning, I think that's the US market. And, I kind of called it out about a fortnight ago across many channels that, US is a market, you should be sort of super wary of and, exit risk as much as you can there.
So, Manish, Indian equities were the only game in town, and now everyone's talking about how asset allocation. So, if all options are open on the table, it's not for Indian equity investors, etc., people who are watching predominantly, but still, if all options were on the table, which asset class is now best placed? Give us your pecking order.
Sort of as a top-down asset allocator or macro allocator, you sort of first look at territories. So, of course, US is a market, at least personally I've been sort of overweight on because it's primarily a US dollar call. But at margin, of course, as I said, that looks the most fragile market. You really can't do big bets or position sizing in China and Europe. But almost certainly, Europe seems to have woken up. They seem to have sort of, turned back to sort of more defense spending, higher fiscal deficit. Of course, that means Europe most probably will not be sort of weaker forever, will begin to strengthen. And of course, bonds are taking a hit there. So I guess, Europe is a small market, that you could do a little bit of a position sizing. China, again, moves sort of from one extreme to another, from sort of a darling of the market to, non-investable market. But again, small positioning there. But for the local investors, I understand that, mostly it's going to be a call between fixed income versus equity. And I made this point to you since last September, October, that, it's likely that for 3-4 years, bonds, simple bonds, fixed deposits will likely earn more than equity. So I don't sort of want to change that view yet. I think, Indian markets are still sort of fragile. I think the positionings are very, very strong. Margins still have to roll over. And the scarrings of last 6-8 months will stay. So I think it's going to remain a sell on sort of rally instead of buy on dip market for at least 6 to 12 months time.
Thank you so much, Manish, for joining us and giving us your view as far as various asset classes are concerned. Well, time now for a short break. Parag Thakkar from Fort Capital joins us next to discuss the latest trends from banking sector and the developments related to IndusInd Bank.
Welcome back. IndusInd Bank has recovered today, 2.5% higher. It's come off from the highs, but still, after the thrashing that it got yesterday, there is some green on the screen. The management exclusively told CNBC-TV18 that although there could be some decline in the net interest income in Q4, the bank will show a profit in the fourth quarter. Listen in.
what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
To take the discussion forward, Parag Thakur, Senior Fund Manager at Fort Capital, is now with us on the show. Parag, you would have analysed IndusInd Bank even before the events of the last 48 hours unfolded. The RBI extension coinciding with this update about discrepancies in their derivatives portfolio. Were you bullish on IndusInd Bank in the first place? And now what have you made of these recent updates?
So basically, first of all, thanks a lot for having me on the show. So IndusInd Bank, basically from valuation perspective, always looked very attractive. The only problem was when the microfinance issue started, we became very cautious and we sold it out. And luckily, so we were not holding any IndusInd Bank stock because of and not because of this particular episode, but we sold it because we thought that 11% of the loan book was microfinance, and microfinance was going through a lot of stress, and we were not finding any answers to that. And so we sold. So we just got lucky, I should say. And after this now, in my view, of course, management has clarified a lot of things, and promoters have also given statements that they are ready to increase stake and all. But I would say that the governance part of it, I think, because every bank, what I am being told is that after 2013, when taper tantrum had happened, RBI came up with many regulations in order to restrict this forex swap-related losses, and which can be reported on M2M basis. I would say that I would still go with banks like Kotak, ICICI kind of banks, or HDFC Bank kind of names, where you are 100% confident that this kind of episode is not going to happen. And plus, there are other tailwinds also. Definitely, as you were discussing just now, that the entire growth narrative of US is taking a backseat, and so there is a selling in US market. We are hoping that some part of those can come back to India, and which can come into large cap banks, because what they sold was large cap banks. So from that perspective, we like Kotak the most, because it is the most, I would say Kotak and ICICI, followed by HDFC Bank, of course. They are most well-governed banks, and plus Kotak has many levers. Recently, their embargo got lifted on credit card. Their NIMs are 4.93. And I think they have very good levers to protect their NIMs in terms of their CET1 is 21%, CD ratio is 87%. Plus now they can grow their credit card book, which is high yielding, so they can protect their margins that way. Plus they have a very good secured retail book, which is construction equipment, tractors, which is doing well because of rural India recovering. Commercial vehicles, where they yield slightly higher than mortgage and AAA rated corporates, right? So they have margin levers also. They have clearly stated that their growth will be 1.5 to 2x nominal GDP growth. So there's a growth also, there is some margin protection also, and asset quality as usual remains pristine.
Right. Parag, take that point completely. You didn't have IndusInd Bank in your portfolio, but the stock is now almost 50% cheaper from where it was, maybe just around 6-8 months back. So at this price, does it warrant a fresh look at? And the other bigger worry as far as mid-cap private banks are concerned is there a possibility of a contagion effect? Could other banks see something similar play out? And in that case, would you like any of the other names? Some of them have seen significant corrections, names like AU Small Finance, an RBL Bank, a Bandhan Bank. Would you like any of those names?
No, I will. So it has been my stance since long that I have to be in a lenders where I am confident about governance first, and second, it should be a secured lending, whether it is banking or NBFC. I prefer secured lenders because in unsecured lending, when economy goes through such kind of problem, when last year government was not spending because of election when RBI was keeping liquidity very tight to control inflation. In this kind of environment, if you have an unsecured loan book, it becomes very risky. So my entire portfolio is tilted towards secured lenders, whether it is Kotak, ICICI, SBI, or whether it is Federal Bank in the mid-cap space. So my portfolio, and I like to keep it that way only because I don't think so that, see, what I'm feeling is that government has started to spend. The effect of that has still not transmitted in the economy on the ground. RBI has done phenomenal work by infusing liquidity, by reducing repo rates, but that will show result in 2 to 3 quarters from now. So it is not a time to take extraordinary risk in the market. And lending is a very risky business because 80% of your total book is borrowed. So it's a highly leveraged business. So you have to stay with disciplined, well-governed, secure lenders. That is the message.
Understand that and take that point completely, Parag. Thank you so much for joining us. Hope to see you more frequently on the channel. Well, time now for a short break. We put the spotlight on JP Associates on the other side. Welcome back to Trading Hour. Well, in what's a major breakthrough as far as lenders are concerned, sources tell CNBC-TV18 that banks have completed the transfer of 12,000 crores rupees in stressed loans belonging to JP Associates. Ritu joins in with more details.
Well, in what is a landmark resolution for banks nearly a decade in the making, we understand banks have concluded the transfer of stressed loans belonging to Jaiprakash Associates to the National Asset Reconstruction Company, or NARCL, and against a principal outstanding amount of 14,500 crores, these 25 banks led by State Bank of India and ICICI Bank get 12,000 crores from NARCL. Of course, the total outstanding debt for JP, including all of the overdue interest, penalties, etc., is well over 52,000 crore rupees. Now, the deal follows a 1585 structure, meaning 15% upfront cash, which is about 1,800 crores, and the rest in the form of security receipts. But importantly, this will reflect in the bank's balance sheets in the current quarter itself. Among the key lenders, SBI alone has recovered about 500 crores in cash and another 840 crores in security receipts. ICICI Bank has received 270 crores in cash, another 1,550 crores in security receipts, and IDBI Bank, Axis Bank, LIC and Canara have also secured recoveries through the transaction, among others. Now, while most of the banks did agree to the transfer, Yes Bank and DBS Bank, with very small exposures, we understand, opted not to participate in the sale. But importantly, even though banks have now transferred this exposure to NARCL, the resolution of the company will continue under the IBC. We understand the deadline for submission of expressions of interest has now been extended to the 25th of March, and the ultimate recovery through the security receipts will be dependent on this resolution. Nonetheless, a significant development for banks in the case of JP Associates, which has been an NPA since 2016 and at the center of one of India's most protracted corporate debt struggles.
Thank you, Ritu, for that. By the way, markets are slipping. Now sub 22,350. A level to watch will be intraday low of yesterday, 22,314. That was the low the markets hit yesterday, and whether we can hold on to that level. For now, things are looking weak. Benchmark indices down over 0.5%, mid-cap index down 1.5%, nearly 1,800 stocks declining. IT continues to remain under pressure, but Reliance Industries too has dipped into the red. It's a wrap on Trading Hour. Thank you for watching.